All right, so gold, and it's been making some big moves lately.
Yeah, I have.
Hitting a record high just the other day. Actually, March 18th, we saw it hit $3,051.99 an ounce.
Yeah, that's a big number.
Yeah. And even as we're recording this a few days later on the 21st, it's still hovering around $3,041.
Still strong.
So the question for our listeners is, what does this all mean?
Right. Is this just kind of a blip on the radar, or is there something more significant going on here?
Exactly. Like, are these just numbers on a screen, or is something bigger bubbling under the surface?
Well, that's what we're diving into today.
Yeah, we wanted to really get into the nitty-gritty of this gold surge, and we've got some interesting sources to help us unpack it all.
Yeah, so first off, we've got a recent market report that really highlighted that peak price we talked about and where it's sitting right now.
Right, and then we also dug into this really fascinating YouTube discussion with some heavy hitters in the financial world.
Oh, yeah. You're talking about Rick Rule, Andy Schectman, Peter Schiff.
Those guys, exactly.
I mean, these guys have been around the block. They've seen it all when it comes to these markets.
Totally, and one thing that really jumped out at us from their conversation, and it actually kind of surprised them too, was something that didn't happen at a recent FOMC meeting.
Right, the Federal Open Market Committee.
Yeah, so during the Q&A with Fed Chair Jerome Powell, not a single person asked him about gold breaking through that $3,000 mark.
It's interesting, isn't it?
It is,
Yeah.
and all three of these experts agreed that this silence speaks volumes.
Yeah, they're seeing this price of gold as a potential signal, maybe even a warning sign about what the Fed is doing with monetary policy.
Okay, so let's break down this whole idea of gold as a warning signal, because they even brought up Alan Greenspan to illustrate this point.
Yeah, Greenspan, that's going back a bit.
All right, so back when gold was trading in that $300 to $400 range, Greenspan apparently used that price as a gauge to determine whether monetary policy was too loose or too tight.
Basically, he saw it as a barometer for the economy.
Exactly.
Yeah.
So if gold started creeping up towards that $400 mark, it could mean that the Fed's policy was a little too loose, potentially fueling inflation.
Yeah.
And that maybe they should think about tightening things up a bit.
Right, make things a little less easy.
On the flip side, if it dipped below $300, that might indicate the policy was too restrictive.
Holding things back.
Yeah, potentially stifling growth.
Yeah.
And suggesting the Fed maybe needed to ease up a little.
So interesting to think about that historical perspective, because now we're looking at gold well above $3,000.
Right, like way above.
So the question is, what does that tell us about the current monetary policy if we apply that same thinking that Greenspan used back in the day?
Yeah, that's a big jump to ponder.
It really is.
And here's another thing that really caught my attention. One of the experts pointed out that if you price the S&P 500 in gold instead of dollars, it's actually down a whopping 60% since the year 2000.
Wow, that's huge.
It is, and their interpretation of that is really important. They're saying that a big chunk of those stock market gains we've seen over the past couple of decades might not actually reflect real growth in company value.
You mean it's not all as rosy as it looks?
Right. It could be that a lot of it is simply due to inflation and the declining purchasing power of the dollar.
So basically, the value of the dollar is going down, but the stock market is going up.
Exactly. And that can create the illusion of growth when in reality, it might just be that we need more dollars to buy the same things.
So the question for you, the listener, is how does this change your understanding of how the market has actually been performing these past 20 years?
Right, because just looking at the numbers in dollars might be giving you a skewed perspective.
Yeah, it makes you think, what's the real underlying growth here? Are we truly seeing companies expand and create value? Or are we just witnessing more dollars chasing the same amount of actual value or even less?
Exactly, and that's a really important distinction to make.
It really forces us to consider what measuring stick we're using to gauge success in the market.
Now let's shift gears a little bit and talk about the actual mechanics of these precious metals markets.
Okay, the nuts and bolts.
Exactly. Because these experts raised some concerns about the LBMA and COMEX.
The London Bullion Market Association and the Commodities Exchange.
Yeah, and it seems like there's a bit of a disconnect between the amount of physical gold and silver that's actually available and the number of contracts that are floating around on these exchanges.
Right, so it's like a bit of a balancing act, a tightrope walk.
Yeah, and to understand the scale of this, they threw out some pretty startling numbers.
Okay, lay it on me.
So in London, for example, they estimate there's about 279 million ounces of gold held in total.
That's a lot of gold.
It is, but here's the thing. Only about 36 million ounces of that is actually readily available for delivery, like right now.
Oh, wow.
Yeah, and then you compare that to the approximately 380 million ounces worth of outstanding spot contracts that are out there.
So basically, there are about 11 times more contracts than there is gold ready to back them up.
That's exactly what they're saying.
And what about silver?
Well, silver's in a similar boat. They say there's roughly 290 million ounces of silver available, but a massive 2.9 billion ounces in contracts. That's a tenfold difference.
10 times more contracts than silver? Wow, that's
Yeah.
a huge discrepancy.
It is, and the experts are suggesting that this isn't just a simple logistical issue.
Right, like it's not just a traffic jam trying to move the metal around.
Exactly. They're saying it points to a potential erosion of trust in the system's ability to actually deliver the physical gold or silver when those contracts come due.
So it's about whether the system can actually back up its promises.
Right. And adding fuel to this fire is the massive amount of silver that's been flowing out of London recently.
Oh yeah, how much are we talking?
Get this, 128.57 million ounces have been withdrawn from London vaults just in the last 3 months.
Wait, almost half of the available silver has vanished in just 3 months.
That's right.
That's wild.
It is, and it really underscores that point about a potential lack of faith in the system's ability to actually deliver the goods.
So where do they see this all heading?
Well, they're predicting a potential shift away from these established Western paper markets.
Oh, interesting. So moving away from those big exchanges.
Exactly, and they think we might see a move towards more cash-and-carry exchanges in places like Shanghai, Moscow, Dubai.
Why those places?
Well, their argument is that these exchanges might offer a more realistic and reliable way to determine prices because they have a much higher ratio of physical metal backing up the contracts that are traded there.
So it's more grounded in the actual physical commodity.
Exactly. And it makes you wonder if this geographic shift could have broader implications for how global prices are set and who really holds the reins in these crucial markets.
Yeah, it's not just about where you buy and sell, but who has the power to determine the price.
Exactly, and that's a big question to consider.
It really is.
Now let's zero in on silver for a minute because Rick Rule had a particularly interesting take on this. He sees silver as being more volatile and speculative than gold.
Oh, so a bit of a wild card.
Yeah, he thinks it often really takes off later in a precious metals bull market.
So it lags behind gold, but then can really surge.
That's his view. And he highlighted the potential for something called a short squeeze in silver, specifically in vehicles like PSLV, which is traded on the New York Stock Exchange.
Okay, remind me what a short squeeze is again?
So basically, you've got some investors who are betting that the price of silver is going to go up, right? They're aligned with that precious metals narrative.
Okay, makes sense.
And then you've got others who are betting against it. They're taking short positions.
So they're hoping the price goes down.
Right. And Rule's point is that if a lot of people are shorting silver and the price keeps rising instead of falling,
Uh-oh.
yeah, they could be forced to buy back silver very quickly to cover their positions, and that buying frenzy can push the price up even higher.
So it becomes a self-fulfilling prophecy in a way.
Exactly. And he's seen this happen before. He's been through some major short squeezes in silver-related investments in the past.
So he's speaking from experience.
He is. And let's not forget about central banks around the world and the impact of the Basel III Accords.
Right, those international banking regulations.
Yeah. So apparently, many foreign central banks have been buying up gold lately.
Interesting, so they're adding to their reserves.
Exactly. And while some aspects of Basel III might have loosened the rules a bit for banks holding physical gold.
So it's a bit easier for them to do.
Yeah. The experts believe that other parts of those regulations related to how banks classify reserves and handle debt instruments could actually indirectly benefit gold, especially during times of economic uncertainty.
Because gold is seen as a safe haven.
Exactly. It's that classic safe haven asset. And it's worth noting that major banks now classify gold as a Tier 1 asset.
Tier 1, that's the top tier, right?
It is. It's like the safest, most liquid asset a bank can hold.
So that's a pretty big vote of confidence in gold.
It really is. And finally, they touched on the market's immediate reaction to the latest FOMC meeting.
Okay, what happened there?
Well, even though interest rates stayed the same in the U.S., the major stock market indexes saw their biggest gain since the middle of last year.
So the market liked what it heard.
It seems so, and this seems to have coincided with the Fed's announcement that they're slowing down the pace at which they're reducing their holdings of securities.
So basically, they're taking their foot off the brake a little bit.
Right, and the market interpreted that as a slightly more dovish stance on monetary policy, a little less aggressive.
So maybe things aren't going to be tightened up as quickly as some people thought.
That's the general feeling, and it's also worth mentioning that both the Bank of England and Sweden's Riksbank decided to hold their policies steady around the same time.
So a lot of central banks pumping the brakes a little.
Yeah, kind of a global trend there.
Interesting.
So to sum it all up for you, our listener, What are the key takeaways from this deep dive into the gold rush?
Well, first off, these record-breaking gold prices could be a red flag signaling some serious concerns about the Fed's current monetary policy.
Like maybe they're not as in control as they want us to believe?
Right. And then there's the whole issue of the stock market's performance. Those impressive gains we've seen over the long haul might not be as solid as they seem.
It could be a lot of smoke and mirrors.
Exactly. It's possible that a big chunk of those gains can be attributed to a weakening dollar rather than actual growth in company value.
So we need to look beyond those flashy dollar figures.
Absolutely. And then there's this whole question of trust, or maybe the lack thereof, in those traditional Western precious metals markets.
Yeah, the LBMA comics situation.
Exactly. It seems like there might be some real vulnerabilities there and a growing sense that the system might not be able to deliver on its promises.
So maybe we're seeing the beginnings of a power shift in the precious metals world, a move away from those Western hubs towards places like Shanghai, Moscow, Dubai.
Yeah, those cash and carry markets where physical metal plays a bigger role.
Right, and then of course there's silver, our volatile friend.
Always ready to make a splash.
And with all this talk of short squeezes, it could be in for a wild ride.
Definitely one to watch.
And finally, let's not forget about those central banks quietly stocking up on gold and the way that Basel III could be indirectly supporting the precious metal.
Yeah, even though it might not be the main intention.
Right. But the fact that gold is now considered a Tier 1 asset by major banks speaks volumes.
It really does.
So all in all, it's a fascinating and complex picture.
It really is.
And remember, these are just the insights we've gathered from the sources we've explored.
Right. It's important to do your own research and come to your own conclusions.
Exactly. And on that note, here's a final thought for you, our listener. Given all these different perspectives on gold, silver, and the global financial landscape, what are some unconventional indicators or data points that you might want to start paying attention to?
Yeah, what can you look at to get a clearer picture of what's really going on?
Right, because there's always more to this story than what meets the eye.
Absolutely. So do your own digging and see what you uncover.
And that's a wrap on our deep dive into the gold rush.
Until next time.
Take care.